With crypto prices changing so quickly, investors, especially beginners, might get completely lost. Today, we'll find out why and how the crypto prices change and look into some of the ways to make predictions. My name is Dan. Let's get started. It's a given that prices in the crypto world are very volatile, and that's a fact we've had to deal with the whole time they've been around. But what exactly affects the price of cryptocurrencies? There are a few factors. For example, supply and demand. This basic economic principle works on crypto as well. If the demand for a particular cryptocurrency is high and the supply is limited, the price will increase. It works the other way around too. Competition. If a new cryptocurrency with better features and benefits is introduced, investors may shift their investments, causing the price of the older cryptocurrency to fall. Market sentiment. The general attitude of investors to a particular cryptocurrency have a significant impact on its price. If investors are optimistic about its future, the price will likely rise and vice versa. News. Events such as technical upgrades, regulations, and partnerships can have a significant impact on its price. Utility and adoption. The more a cryptocurrency is accepted as a means of payment, the more valuable it becomes. What's more, negative user experience such as high fees, security breaches, and so on might lead to a decrease in its value. Global economic conditions. If there is uncertainty or instability in traditional markets, investors may turn to safer options. For example, government bonds, and the crypto prices can drop. So does it all mean that crypto prices are completely unpredictable? The good news is that there are some ways to know ahead of time if a coin is going to grow or decrease in price, even though it's not easy by any means. Let's take out the two most common types of analysis. We'll start with a technical one. This is a method of analyzing financial markets, including cryptocurrencies, by looking into the historical price and volume data. People use technical analysis to find patterns and trends that can help predict future prices. The basic principle of technical analysis is that once market trends are established, they tend to continue. Technical analysts use charts, support and resistance levels, trend lines, moving averages, and various other indicators. Technical analysis includes these general steps. Number 1, identify the relevant time frame. Short-term traders may look at hourly or daily charts, while long-term investors may look at weekly or monthly charts. Let's look at this graph. On the BTC hourly time frame, we observe a local accumulation phase in the form of sideways movement. The logic behind this formation is probably that a large participant in a specific price zone gained a sufficient position for a further price pump or dump. Now here on the daily time frame, we see more clearly a consolidation between an important level, which has acted as a global support level. The weekly chart reflects the consolidation below the level that has historically been a strong support level and is currently acting as a resistance level. The monthly chart shows buyers' interest with 3 green bars of trader volumes. Participants continue to accumulate positions at low prices for the prospect of BTC's future growth. Number 2, identify trends. Look for patterns in the price data. For example, uptrends or downtrends. You can use such tools such as trend lines, moving averages, and chart patterns to help identify these things. Here we can see how the downtrend stopped at the price of $21,375. And then there was an increase in highs and lows, which indicates the formation of an upward trend structure. Number 3, identify support and resistance levels. Support levels are price levels where buyers are expected to enter the market and prevent the price from falling further. And resistance levels are price levels where the sellers are expected to enter the market and prevent the price from rising further. In this case, on the 4-hour price chart of Ethereum, we see how the resistance level breaks through and then acts as a support level. Note that support and resistance levels are built from 2 points or more at the same price level. These levels can be identified by looking at historical price data and chart patterns. Number 4, use indicators. For example, if the relative strength index indicates that a cryptocurrency is oversold, it may be a good time to buy. Let's look at this daily chart of SOL cryptocurrency. The RSI indicator around 45.93 will be interpreted as a neutral status. If the line chart of the indicator reaches the upper border of the zone at around 70 and above, the coin receives the overbought status, which means that the price is very high at the moment. If the RSI line drops to 30 or lower on the RSI scale, the coin gets the oversold status, which may indicate that the price is favorable for buying. Number 5. Keep an eye on the trading volume. High trading volume can be an indicator of a strong trend or a trend reversal. Look for significant changes in trading volume that may indicate a change in the market sentiment. Here's an example. This chart illustrates the uptrend formation, which is accompanied by increasing trading volumes. It is also worth paying attention to outbursts of activity of buyers on breakdowns of levels. Now, the second type of analysis that crypto investors use is fundamental analysis. Unlike the previous method, it focuses on looking into the underlying fundamentals of a cryptocurrency. For example, its tokenomics, management team, market share, investors and activity, and so on. The main goal of fundamental analysis is to find those tokens that are trading at a discount to their true value. Here are the main steps of fundamental analysis. Number 1. Analyze the project, its underlying technology, use cases, and development team. You can also look at the project's white paper, roadmap, and other documents to get a better understanding of its goals and plans. Number 2. Evaluate the market. Look at the competition and the demand for the product or service that it offers. You can also take into account the size of the market and the potential for growth in the future. Number 3. Review available financial information. This includes market capitalization, financial audits of the crypto companies, etc. Look for trends in these metrics and evaluate the financial health of the project. Number 4. Monitor news and events. Keep an eye on what may affect the cryptocurrency market and the coin you're researching in particular. Stay up to date on the latest developments in the industry. Subscribing to our channel will help you do just that. Remember that you can't rely on just one method to predict the price of cryptocurrencies. To make smart investment decisions, it's best to use both types of analysis we've discussed and stay up to date with the news and events that can affect the market. All in all, while analysis methods are very helpful, it's always important to exercise caution and use proper risk management strategies if you're investing in cryptocurrencies. Leave a like if you found this information helpful, and don't forget to subscribe and turn on your notifications to not miss out on our new videos. See you soon!